Good evening, this is Ken Long from Tortoise Capital with a review of the weekend trading plan for September 16th, 2012. We have a market that's in bullish, quiet conditions. On an annual basis, using weekly RSI 14, we're overbought with a reading of 70 out of 100. It's the first time that's happened in a couple of years. On a short-term basis, the 10-day NDX reading is at 103, also overbought. Price relative to the 200-day moving average is at 9.50% or white bullish. Slope of the 50-day moving average has improved to 0.68%, which is green bullish. ADX, the measure of trending, is at 27.3 and is indicating a strong upward trend. The ATR percentage at 0.87% remains exceptionally quiet. So we're a bull quiet market and overbought conditions on a short-term basis. Blended monthly rebalancing, the 26 ETF portfolio still holding DBA, which is agriculture, Australia, and Asia less Japan. The 13 ETF portfolio is EWA, Australia, Asia less Japan, and the NASDAQ 100. Next reevaluation on or about 1 October. ETF2, the theoretical exposure is at 100%, and the model portfolio is also at 100%. Quick look at the blended monthly rebalancing portfolios. EWA, EPP, and then IWM has moved into third position ahead of the Qs. At 26 ETF portfolio, it's emerging European markets, then the European 350, and then the Energy Spider XLE. That's a function of rising oil prices and the threats between Israel and Iran, and imminent danger in the Straits of Hormuz. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple line is a swing high at about 148, which was reached on Friday. The horizontal red lines represent support levels that have held in the past. The central black line is the 30-period regression line. The outer black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period. You can see we've emerged out of the sideways quiet channel that I've highlighted in yellow, and now we're above the river, which is the 30-period Bollinger Band plus or minus 1 standard deviation, and we're pushing to new annual and 4-year highs. The red line is the 200-day moving average, and that would be the boundary of bullish. That would be the boundary of bullish, bearish conditions. You can see we're still overbought on a 10-day basis. The jaws of PPO have opened up, pointing up. That's still favorable. The ADX climbing to 27, and bulls are definitely in charge. These two shaded rectangles represent a 5% and then a 10% pullback from the swing high. Anything from 0 to 5 we'd classify as noise. 5 to 10 would be a correction inside a bull, so you can kind of see where we're at. You have the 10-period moving average is just getting ready to come out of the river. The river has left the 50-day moving average. That's a very favorable sign as well. So we do have some room to run. The first support level of significance would be about 143, which would be around a re-entry of the river. So all systems go, pointing up. Let's see what the news in the Middle East has to say. ETF2 regional report, everything's on a buy signal. The strong SPY, the U.S., is stronger than EF8. 54 is better than 48. You can see the weakness in Japan, the strength in Europe, continued weakness in Latin America and emerging markets. Inside the U.S., it's the NASDAQ, then the U.S. large caps, then the small caps, then the mid caps, with the SPY and the Qs being the strongest sectors and Latin America and Japan being the weakest. World market model, we see strength in commodities and silver, which have had a really nice run. I think the stealth trade is over on that one, and now it's starting to run away on based on the Fed getting ready to pump and concerns with oil in the Middle East. See extraordinary strength in Europe at the expense of the U.S., which is still above average except for the Dow. Singapore remains strong. China remains weak. Japan very weak. and strength in Mexico in their oil reserves. Now you can see the defensive sectors are starting to suffer here, and now it's energy and finance beginning to take over. Quick look at the ETF top 30. What I'm looking for is things that were strong on the average but are starting to weaken. That's an indication of a changing of the guard here. You can see it's the bonds are starting to weaken, definitely the short-term bonds. And then you would see strength in Sweden, where the strength and consistency are high, higher than the average score, and so that's an indication of who the new leadership will be. Mexico especially looks interesting. Right now it's still grains and home construction, mortgage REITs still at the top. Using the same kind of strategy now for the Dow 30, although this time we're going to sort it by relative strength. And still Home Depot, Walmart, Merck, Disney, Bank of America. Weakness in Hewlett Packard, Intel, Boeing, and McDonald's and Caterpillar. So if you're a value player, that's where you ought to be looking. If you're looking to maintain the continuous riding the momentum, then you'd be looking at the top of that chart. Quick look at ETF liquidity for intraday trading. The VIX is back up to almost 6% intraday volatility, and natural gas also extremely volatile. Then I find this pretty interesting. IWM is now 50%, more liquid than the Qs in terms of average daily dollar volume. So that's really the trading instrument of choice. Looking at the regression line crossover in four markets, the gold stealth trade is over when it emerges from the river after a period of sideways quiet channel. That's when we tap into it. The timing on that was excellent for us. Treasuries have broken down as part of this runaway bull. I also think that becomes an attractive play if we get that Middle Eastern issues and flight to quality. IWM has now gotten over its annual high and is clearly out of the river, with both regression lines having left the river. So that looks good. We're going to leap ahead now to the daily. I won't read the top again. We've seen that already. No signals in channeling and overreaction. You can see that we've remained overbought here on the 10-day NDX. The standard deviation of the gap in SPY remains starting to get a little bigger now with a 0.6%. That's the overnight risk that you're looking at. You can see that the S&P volatility has declined and still is very quiet, but slowly starting to increase here as we've gotten out of that sideways quiet channel. ADX definitely pointing the way up. Only a few patterns in channeling and overreaction among the large caps. You can see the 10-day max pain losers, Intel, Kraft, Bank of America, AT&T, and Merck. In the ETF 100, it's VIX Treasuries, dollar up. That's the strong dollar, natural gas, and then IEF. I think that's European growth. Looking at the Dow tactical summary, we only have a couple dojis in Kraft and American Express, two channelings in Kraft and Pfizer. Overreaction in Kraft. The two max pain candidates, Intel and Kraft, based on those the bad days or bad weeks they've had at minus 10% here, or over the 10 days, minus 5.9 and minus almost 4%. Max pain range compression candidates, and then two test out at better than 2-to-1 on the auto framer. That's Intel and Kraft. Intel ought to be on your radar screen, as is Kraft, for that very reason. I have not participated in the bounce. Same logic looking at the ETF 30. A lot more dojis, no patterns to speak of. The VIX and Treasuries both testing out at better than 5-to-1 reward to risk on the auto framer, so that's absolutely worth looking at. Treasuries had a horrible close. finishing up at 1 on a scale of 0 to 100 for RSI 2. So that will be one to watch for swing trading. All of these symbols here in the green are ETFs that have closed higher than their previous trading range for the last X periods, so 10-day, 1 month, 3 months, 6 months. So you can see just how broad-based the moves this week have been. Looking at the market mosaic indicators, you see the regression line and how the train has left the station, leaving the sideways quiet channel behind. Some would be concerned, and I am one of them, about this potential falling star doji here at 148, now back to 147. You can see the regression line slope has just crossed its 10-day moving average back to the upside, which suggests there's more room for this to go. And the percent stretch above the 200-day moving average is not extreme, although it's made a 1 standard deviation move above the historical average of the last 6 months. There's still room for it to make another 5% move, and that's another $8 in the S&P. The 90-day regression line, the Z-score has left the normal range of plus or minus 1, joined by the 10, and even the 30 has rolled up. And so this also supports the potential for another 5 to 8% move up. But in my view, still prior to the election and with trouble in the Middle East, a retracement here is much more likely in a return to normal. You can see here on the zoom in on the river, the 30-period Bollinger Band river, and the price the last 180 days has been riding this, the upper Bollinger Band, has now left the station pointing upwards, so that's very favorable, characteristic of a bull. Bollinger Band channel width is very low, still about at minus 0.5, so it's extremely narrow. That's a breakout from sideways quiet channel that we're seeing, so more room for that to go. And you've seen this chart from the weekly, looking at the regression line crossover in Bollinger Bands. Quick look at the Dow 30 and the ETF 30 from a frog perspective. Quite a number of them still above 3.0. Coke, Hewlett Packard, Walmart, agriculture jumps out at me. Caterpillar is green on both weekly and daily, as is United Technologies. This is your fail stat. This measures how far from the open to the low of the day, and expresses that as an average, and then plus or minus 1 standard deviation. Signal to noise ratios, the high scores here indicate strong intraday moves or trending intraday moves. The ones in red are ones that tend to give back a lot of those moves, so they have relatively fat tails compared to those that are in the green. So one way to look at this is Coke at 0.53 has tails that are half as large on average as those of Microsoft. Taking a look at the holding X-day periods, all the 40-day Z-scores are up right at the boundary of 1.0. So that's been just starting to become an exceptional move over the last 40 days. Over the last 20 days, still within the bounds of normal. The last 10-day move has been exceptional because they're mostly all above 1.0 on the Z-score. And same with the 5 days, not quite so horrible or excessive. Looking at the 30-day relative strength score, after we've subtracted out the zeroed it out from the market, so we've normalized that. You've got technology here has room to go, and that's why I think Intel, United Technologies would be worth your while to look at. See the strength in all the overseas market relative to the UX, and the strength in gold pulling back just a little bit, and oil getting ready to surge some more. So this has definitely been a euro-led commodity-led recovery. Quick look at the safe zone and intraday range percentages in the 30 and 200-day averages to give you a size estimate of the reasonable intraday moves that you can expect. So the ETF suspects across the top, and then the Dow 30. That's all I want to cover today. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured. I'm expecting some tests of confidence here with this Middle Eastern shenanigans in the Straits of Hormuz. This is not looking good. So keep your powder dry.